Welcome to the Bangers Only podcast, where Tom Lydon and his band of experts make money talk exciting. Here's your host, Tom Lydon.
Welcome to the Bangers Only podcast. Life is short. We got to keep things simple. Use your time to focus on what's most important. That's what Bangers Only is all about. I'm Tom Lydon, and joining me today is Brent Sullivan, who's the founder of Tax Alpha Insider. Brent, welcome. Great having you.
Oh, happy to be here, Tom, and talking about Tax Alpha all day, all long.
Well, what is Tax Alpha, and what's the whole mission behind Tax Alpha Insider?
So I write nuanced content for high net worth and ultra high net worth advisors primarily. And so oftentimes I'll have folks come through who want to read it for their own purposes, but it's a blog dedicated to product strategy and wealth management planning for high net worth and ultra high net worth, focused in the tax aware space.
Okay, so is this only for rich people, or can we run through some things today that the average investor probably should know, and it may pay for them in the years to come?
Oh, yeah, 100%. Yeah, there's a ton of stuff that investors should just be aware of when they're selecting products that can improve their tax efficiency, try to make that number at the end of the year or the tax liability go down a little bit.
And I gotta say, after following you for a while, subscribing to your blog, you do this in a very unique way. You find a way to have fun with the whole subject around taxes. When did the whole thing start? Because taxes tend not to be that fun and exciting.
Well, so I always say, like, if you like to play games, if you like rules, then tax management is really an exciting area to be in. And I think most people don't believe me when I use the word exciting, but there are just so many stones to turn over in this space that I find it endlessly fascinating. And it doesn't matter what your wealth level is. It doesn't matter what product set that you're interested in. You know, it could be listed, it could be private, whatever. There's going to be some way that you can sprinkle in tax efficiency. And just like trying to make that fun, I think is like a daily interest, hobby, obsession for me.
Well, it's refreshing. It's real refreshing, and I crack up at some of the caricatures that you share, and it's great. But every discussion on investing usually comes back to one thing. It's not what you make, it's what you keep. And the real differentiator now is tax efficiency. Who can deliver returns where you don't have to give half of it back in April, right?
Yeah, 100%. And so, yeah, what I'm seeing is at all levels. So you have advisors who see themselves as tax aware, and that's a practice differentiator. It's how they win business. But then I see investors increasingly themselves interested in tax efficiency. They're looking at the Morningstar tax cost ratio of various products. They're weighing how certain product selection or asset allocation is going to impact their tax liability this year and in the future. So I just see like a broad shift toward tax efficiency and awareness.
So let's talk to the average investor out there. Here we are, we're wrapping up 2025. Usually at the end of the year, there's some things that you can do to be more responsible in a tax efficient way. Maybe run through a couple of those.
So I've got three that I always think they're relevant, you know, depending on the circumstances, but there's three different areas that I always think about. So the first one is, of course, tax loss harvesting. So what that is realizing losses. Maybe you sell some losers, replace that exposure with something different. But if you realize those losses, then those losses can be used to offset gains that you might get somewhere else in the portfolio. Realized gains, not distributed gains. That's a different story. So if you're doing some tax loss harvesting, you can do it all year. But, you know, if you haven't done it all year, maybe there's an opportunity at the end of the year here to bank some of those losses that you can use against gains elsewhere. That's the first thing. The second thing is that a lot of these income products, or maybe interest income products, could be derivative income products. A lot of them are going to be churning out income of some sort. Could be interest, could be capital gains. But if they've been shoving yield at you, generally it's taxable. Not always. There's return of capital, but generally it's taxable. And if it's taxable, you might want to consider adding all those numbers up and making an estimated payment to the government. And the reason is that you don't want to get surprised next year and get a penalty. So now's the time to do all that tabulating, get all the pluses, get all the minuses, and just see where they are. And if you have to write a check, try to do it before the year ends so that you avoid any penalties. Do your cost benefit analysis, talk to your accountant. But if you need to do it before the end of the year is the time. And then the last thing is gifting. If you're going to be giving away appreciated assets or anything like that, choose the charity, choose the donor advised fund, whatever. Do all that stuff now. Check all the boxes on adjusted gross income and on holding period. Check with your employer if you're giving away employer shares. Like, check all of that stuff now, because it might take some time before the end of the year. And if you're going to do it, then you have to do it before the end of the year. And sometimes it takes a while. So those are the three things: tax loss harvesting, be mindful of those distributions. They might be taxable. And the last one is gifting, especially if the tax laws change and new limits are going to take effect next year. So those are the three things I have in mind.
Great advice, Brent. Brent, we talk a little bit more about ETFs from the investing side. And as we sit here, though, even though they're very popular, there's more money in mutual funds than there are ETFs today. Can you talk about ETFs from a tax efficiency standpoint? How are they able to continue to operate year over year over year? And very few have year-end distributions.
This is the magic of the wrapper. And so what I mean by that is that the ETF has the opportunity to redeem assets in kind. And so what that means is it's not holding a cash buffer, and it's generally not transacting like a mutual fund would in order to raise cash to distribute to shareholders. They don't have to do that. If an ETF needs to raise cash, first of all, it doesn't do that for the same reason that a mutual fund does. But if an ETF is downsizing in a certain way, again, it's totally different than a mutual fund, then they are not forced to trade. They can redeem those assets in kind. And then the market actually has just a fascinating arbitrage mechanism that keeps the fund's NAV and the underlying portfolios, keeps all these things in line. And so that's what's really the value here of the ETF wrapper, is that they don't have to trade in order for cash to, or in order for investors to divest and purchase. They don't have to trade. They have a totally different mechanism at their disposal. It lets them defer capital gains indefinitely. In most cases, there are exceptions, but in most cases.
There have been periods of time in the market where if you're a long-term mutual fund investor, whether the market's up for an extended period of time or down for an extended period of time, and even if it's flat, at the year end, still getting distributions because maybe your fellow shareholders decided they didn't want to stick around anymore. And the portfolio manager was forced at that point in time to sell low-cost basis stock, generating capital gains that the remaining shareholders are being able to get at year-end as holiday gifts. Can you talk about that, and is that still prevalent?
In mutual funds, yeah. I mean, every year we'll get listings of mutual funds that are distributing capital gains, even though maybe the mutual fund's total value went down. I mean, so that's a problematic situation that most ETFs, and I want to say US-based ETFs, there are, again, exceptions, US equity ETFs generally don't have this. They don't have this problem. They can just keep on deferring capital gains internally. Again, they don't have to maintain a cash buffer like some mutual funds have to. There are other solutions for liquidity. But in general, the ETF wrapper and the in-kind redemption mechanism is really what keeps them efficient. I'll put like one little asterisk here, because sometimes people call me out. Mutual funds can also redeem in kind. A lot of people don't know this, and they do it occasionally, but it is just not the same paradigm. So ETFs, when you're thinking of ETF, tax efficiency should be like coming to mind. When you're thinking of mutual funds, it's just different. It's not by default tax efficient. It can get that way, but it's not the default.
Yeah, no, good point. I mean, you're not going to see gold ETFs redeem in kind and mail you gold bars, or municipal ETFs or mutual funds sending you muni notes. It can happen, and it's almost like a threat to redeeming shareholders, but rarely does, right?
Exactly. Yeah, exactly.
Okay, let's talk about evolution, especially in tax efficiency. There's this new evolution in tax efficient income. Can you maybe describe how some of these ETF issuers are able to generate some pretty big annual distribution returns, at the same time participate in the underlying equity indexes. And uh, are they all the same? Are they different? How do you look at this space?
So if I'm thinking about covered call ETFs or various derivative income strategies, generally what's happening is you have underlying exposure. It could be synthetic, it could be physical. It really depends on how the ETF is structured. And they're writing a call option in some way. It could be on the whole portfolio, it could be on a limited slice of the portfolio. The call option could be struck at the money, it could be struck out of the money. It all depends on the structure and how the manager wants to run the product and their growth trajectory, things like that. There are tons of different bells and whistles that these products have attached to them now. But generally, what's happening is they will sell a call on some underlying exposure. And that sold call generates income. It's not actually income technically, but let's say that it's income. And what happens is that that income hits the fund's E&P, that's earnings and profits, and the fund generally has to distribute 90% plus of earnings and profits to maintain its special status and get its own tax exemption. So earnings and profits go up. But one way to defray the earnings and profits is for the fund to do some tax loss harvesting in the core portfolio. So you've got losses from the core portfolio netting with earnings and profits, hopefully to get close to zero. Why would you do that? The reason that you would do that is so that any income, again, it's not technically income, any income that you're distributing from the product is return of capital, which is untaxed. And so there's a couple different situations here, but one more time is you have earnings and profits that goes up when you have option income, and you have tax loss harvesting, which makes that number go down. And anything you distribute in excess of earnings and profits is return of capital, and the return of capital is untaxed. That is the hack. That is what's going on. And I say hack in with a computer programmer's mindset. Like, this is the cool, new, hip, interesting way to distribute income tax efficiently or tax efficiently. 5 asterisks after that. Tom, let me pause. Is that too much?
No, it's great. And look, there are a lot of this was almost really boosted by JP Morgan with their JEPI and their JEPQ products, which are really the leaders in the space. But you've got other leaders as well. Goldman's in the space, First Trust, Global X, Amplify, Yield Max. Neos has been on fire. For full disclosure, I'm actually a part owner in Neos, kind of like Hair Club for Men in a reverse way, let's say. I'm not just a shareholder, but I'm also an investor as well.
I'm not only the Hair Club president, but I'm also a client.
And I've just really, really enjoyed looking at this because they're all unique. They all look at it differently. The different types of options that they buy, they're not all the same. And some options are more tax efficient than others. So that's important to understand. And then also some of these strategies are almost off the chart bonkers with the amount of dividends that they're able to generate. Some of these single stock dividend strategies, what's your take on those?
I don't like single stock exposure, just like as a portfolio diversification strategy. And it really depends on the product specifically and if the risk reward, and I would say after tax risk reward, makes sense. But I would say this, like, if a product is generating a lot of return of capital, now return of capital is great because it's untaxed, but there is a dark side. And the dark side is when return of capital just keeps on eroding portfolio NAV. So we call this destructive return of capital. And so the ideal situation is that the fund is returning capital because it's tax efficient income, again, income with quotations around it. That's great. And the NAV keeps going up. That's the good thing. Return capital, NAV keeps going up. That's constructive. That's fine in general. Destructive is when you're shoving out a lot of return of capital and NAV keeps going down. That's eroding principal. It's harming the overall compounding of the product itself. And so constructive versus destructive return of capital. That's always what I've got in mind when I'm assessing some of these products.
Yeah, and that's very, very important because people get dividend greedy. I mean, if you're getting 30, 40% a year, uh, that's a nice paycheck that you're getting every month. At the same time, the following year, if you've gone down by 40% of your principal, you don't have as much to generate that dividend. So really good point. At the same time, let's touch on return of capital. Now, uh, the tax treatment on the dividends when you have high return of capital is a great advantage. And it doesn't really require a lot for the individual shareholder or investor, because if you happen to custody at a brokerage platform, you get the 1099. That income that's deemed return of capital, Brent, just shows up in another box, and you just give that to your accountant, and they do their magic. And for the most part, you're able to defer taxes on that. However, maybe address the fact that you have to adjust your cost basis by that amount. Correct?
Yeah, exactly. You're going to get a 1099, and on the 1099, there's a box that says, I think it's untaxed dividend, something like that. And what happens when you receive capital back from your original investment is that your outside basis needs to get adjusted. And so that means if you bought something at $100 and they return $10 back to you, that your cost basis is now $90. And this is an important point, Tom. I didn't realize this until maybe like, I don't know, 1 or 2 years ago. But yeah, oftentimes investors need to manually track this. Like the custodian is really not tracking it for them. And so that's something just it's worth keeping in mind, that the cost basis outside your cost basis on the shares that you hold is just going to go down if you receive capital back.
Right. So some platforms do, some platforms don't, but the onus is on you, the investor, and you need to clue your accountant in on that and be sure. At the same time, if you have kids that are looking at your portfolio as well, and you know that one day you might get hit by a bus, all that exposed tax goes away because you have a stepped up cost basis. So you can tell that I'm very careful when I'm walking in New York City with my kids, because those buses come by pretty quickly.
Yeah, no kidding. So yeah, I mean, but you're exactly right. So if principal or if your cost basis outside on the shares that you're holding, if that cost basis just keeps on working down and down and down, let's say eventually it gets to zero. If the fund keeps on shoving out return of capital, you do get taxed on that. That's long-term capital gains, uh, depending on plus or minus. There's some caveats there, but in general, you're going to get taxed on return of capital once your basis erodes to zero. But you're exactly right. You get hit by that bus, your heirs will get full step up. And what that means is, and it depends on if it's a community property state or if it's common law state, so many carve outs. But what that means is that the cost basis will just step up to match the fair market value. And so essentially any unrealized gains in your holdings will disappear.
Bottom line is, Brent, you can tell I'm kind of excited about this because I think this is going to continue to explode. BlackRock says, even though it's close to $200 billion now, they think it's going to be $600 billion in these types of ETFs in the coming years. And looking at advisors who have 60-40 allocations in general and maybe do something around the periphery, these tax efficient income strategies are making their way into the core. And we just need to educate people more about the benefits, but most importantly, your responsibility from a tax standpoint, right?
Oh yeah, 100%. And so I mean the way that I think about it is like you want to select the product with tax awareness in mind. And so if you are selecting a product that's less tax efficient, maybe just think about putting it in a tax advantaged account or a tax exempt account. So there are strategies out there that are less tax efficient, just put them in a tax efficient account. And if you want hyper tax efficiency, some folks using return of capital powered by tax loss harvesting in the core portfolio, maybe that's the place, you put that in a taxable account. But you're exactly right. You want to be thoughtful about where you're locating these strategies. And that just has to be part of your overall strategy.
Well, there are a lot of people who are retired, and if you're late 60s, 70s, even 80s, and you're in good health, you could live for an extended period of time. And we're in a declining rate environment. So your fixed income dividends are probably going to be less than the coming years. I look at it as, I want to continue to participate in equities, but if I can get that higher dividend stream as well, I'm spreading it out and also getting better total return. So I think we're seeing more and more people think that way, which is great. Look, I don't want to get caught up on this area because there's one other area I want to talk about as we are really nerding out on tax code. But talk about 351 conversions and the uniqueness of that in especially in the ETF space today.
Right. So a 351 conversion is the ability to seed a new ETF in kind, not just with cash, but with other securities. And bunch of caveats there, but the gist is that let's say that you've got an S&P 500 ETF and you want to decrease exposure because you're glide pathing into retirement. You want to just take some risk off the table. Well, if there's a new ETF coming to market that offers less beta exposure, you could, in theory, use your S&P 500 ETF to seed the new hedged equity ETF. This is possible. The only thing that's limiting this from happening are two things. One, an ETF needs to come to market with a hedged equity mandate. And also, they need to have the 351 essentially switch flipped on. And so they need to be an ETF sponsor that's comfortable managing the 351 conversion. But at the highest level, I think about it this way. You have current portfolio state. It's your portfolio. It could be individual equities. It could be other ETFs. And you want to transition to a new state. It could be hedged equity, could be more international exposure, it could be diversified exposure, it could be equal weight, whatever it is. You have original state and future state, and 351 just gives you a smooth way to transition from A to B without immediately incurring tax. You're going to defer it, but without immediately incurring tax.
Yeah. And when you think about this boom that we've had, in the Mag 7, for example, there are a lot of individual investors that got onto some of that early, and they're sitting there with really low cost basis stock, and they're scared to death to sell it because they're going to get creamed on taxes. There are issuers out there. I think about Meb Faber and Cambria and what's going on over there. They're actually teeing up 351 funds where you can come in with your low cost basis stock, and there's enough diversification for the other contributors so that it all gets smoothed out and you get a piece of the whole. And I mean, what a great opportunity. I think we're going to continue to see opportunities there. We also have asset managers that have huge separate accounts with low cost basis stock too, that are converting their whole separate account book into ETFs and doing the same thing, right?
Yeah, exactly. So they'll take low cost basis diversified portfolios and then they'll just roll them straight into ETFs that could be publicly accessible or their own ETFs. But yeah, they're using the exact same mechanism. It's Section 351 conversion to do this as a non-recognition event, just to be technical.
Yeah. So getting back to you and your business, you work with ETF issuers to not only help them package the right ETFs for advisors, institutions, shareholders, but most importantly, help on the communication aspect, because it's hard, isn't it?
I think so. I mean, again, you have to be a nerd. You have to decide that this is how you want to spend your time, and most people do not want to spend it in taxation. And so I embrace that burden. Like, let me do that work for you. You can read my blog, or you can listen to podcasts like this to just get like the digest, because it is involved and very, very nerdy, and you just have to decide that's how you want to do things.
So if people want to get in touch with you, first of all, they can go to taxalphainsider.com. And you're also on LinkedIn, you're also on X, and then you've got your own Substack as well, right? So tell us a little bit about that, if you would, Brent.
Oh, so the Substack is just where I write technical materials, hopefully fun, hopefully funny. But the idea is that I want to empower investors and advisors with all of the latest tactics for tax-aware management. I want to essentially take everything that's happening in the industry and put it in front of people in a very concise way. So that's what happens at Tax Alpha Insider. And I go 3 times a week. So, and most of this content is original. It's not summaries. So I'm doing original work all day, every day. This is my full-time job.
Well, you can tell you're having fun. And I really, really appreciate it, because It's a lot of work, and you have to get it right. There's no room for mistakes here, especially from a regulatory standpoint. And look, everyone's enjoyed this nice bull market that we've had. But as we talked about at the beginning, it's not what you make, it's what you keep. And I think you've done a lot to let people keep that much more. So, Brent, thank you. Thank you so much for being with me today. And I'd love to catch up again with you soon.
Thanks, Tom. Sounds good.
The opinions expressed in this podcast are for informational purposes only and are not intended to provide specific investment advice. Any past performance discussed during this program is no guarantee of future results.